Let's talk money.
Welcome back. This week we are discussing how you can look at global equity investing and perhaps consider the mutual fund route when you want to give your portfolio that little bit of global international flavor. Well, let's talk about the cost of this sort of an investment and how it perhaps contrasts with investing in Indian equities. We're in conversation with Dinesh Balachandran as well as Nasser Salim. Dinesh, so let's talk about the tax piece because that changed in the July 2024 budget, right? How is it different from, say, the taxation of regular diversified equity mutual funds, which are investing here in India?
Right. So when you talk about the domestic funds, the holding period is defined on the basis of so there is a short-term capital gains tax structure and a long-term capital gains tax structure. If the holding period of the investment is greater than 1 year, then it becomes long-term. If it is less than 1 year, it is short-term. That's the case for the domestic mutual funds. But when you're talking about global funds or the funds that are investing in international stocks, the holding period effectively is 2 years or 24 months. So if an investor is investing in a global fund and is going to redeem in less than 24 months, then the taxation that they face is essentially a marginal tax or their actual slab rate. That is the taxation structure for less than 24-month holding period. On the other hand, if the holding period is greater than 24 months, then it is essentially 12.5% without any indexation. Again, when you compare it with the domestic mutual funds, if it is less than 12 months or 1 year, it's 20%. And if it is greater than 1 year, there it's the same, it is 12.5%. So the holding period is different and short-term capital gains tax rate is different depending on whether you're investing in a domestic mutual fund or a fund investing in global stocks.
Oh, okay, fair enough. So that's one element, I mean, that we have to factor in when we're looking at post-tax returns. So that's one piece. The other sort of piece is the expense ratio or the costs. And how do the costs of some of these funds, Dinesh, how do they compare and vary versus any normal flexi cap fund or a diversified fund here in India, where the expense ratio tends to be in a band?
Right. So when you talk about a fund of fund structure, so again, when we talk about mutual funds investing in overseas stocks, there are two structures. There are certain schemes that directly invest in global stocks, but most of the mutual funds have a FOF structure or a fund of fund structure, where they are effectively investing in a global fund, which in turn invests in individual stocks. Whenever you talk about a FOF structure, a fund of fund structure, there are essentially two layers of expenses involved. There is an expense involved at the global fund level that you're investing in, and then there is an expense that is involved at the FOF level, the fund of fund level. So from that perspective, you can sort of say that there are two layers of expenses here compared to only one layer of expense if you're investing in a fund that directly invests in specific stocks. But from a practical perspective, when I look at the combined expense ratio, I still feel that for the most part, they are in sort of a very similar band, maybe slightly higher for FF structure, but more or less, when I actually look at the combined expense ratio, it tends to be sort of similar to what we see out here as well.
Okay, so I mean, it's not like it's substantially higher or anything like that compared to diversified equity funds here in India. Got it. Nasser, so now coming to the point in terms of how to reasonably and rationally incorporate some of these global funds in our overall mutual fund portfolio, what is the recipe or the advice that you'd give?
Considering valuations, they're expensive currently in the US. Can one look at a plan where you invest in something like the Russell 2000 index? That is something which has got reasonable valuation, and broad market indices have overperformed. Will sooner or later start to correct to be at more palatable levels. For example, the US equities and specifically Russell 2000 index. That's one opportunity that one can identify. Second is, we talk about markets such as Europe and Japan, from a broader international perspective. Now, the EU is experiencing gradual improvement, driven by easing inflation, will be robust employment and increasing real wages. Now, these factors may support or moderate a GDP growth and consumer spending from 2024 on.
Dinesh, of course, you look at all kinds of markets. You look at, in fact, different asset classes as well. So now you can perhaps wear the fund manager's hat and tell us for not just 2025, say for the next 3 years, if I want to add 5-10% of a global market flavor in my portfolio, then which are the markets that I should look at and not worry? We don't want to lose too much sleep over these kind of investments, right?
Yeah, particularly when you talk about long-term horizons, right? The number one factor to think about is the growth runway. Valuations obviously matter, but as you increase the time horizon, the importance slightly diminishes. When I think about growth runway, I think nothing beats some of these US companies because the kind of spending that they do on R&D, no one else comes even close. And I'm not even just talking about the Max 7, the NVIDIAs of the world. Even like small biotech companies or even small companies in other sectors, there are very innovative companies that do a lot of spending on R&D, and that ensures a long growth runway. So whenever you think about a long time horizon, you do want to invest in these companies that are essentially leveraging R&D spends to build competitive advantage and essentially have a long growth runway. So that definitely has to be a part of the equation. Apart from that, when I just wear the valuation hat, obviously China looks good from a tactical perspective at least, because the valuations are definitely cheaper there. And more importantly, what is happening is that there is a renewed focus by the local government to boost consumption. And that augurs well for Chinese stocks. And so purely from a tactical lens, I think it makes sense to look at China. And I can say the same for Japan, where the argument is really more currency depreciation and what that does for Japanese companies focused on exports. So even that can be an interesting tactical opportunity. But if I have to just think about long-term time horizon, I still would place my bets on good companies based out of US that essentially are doing a fantastic job on the R&D spend side.
Okay, so US, China, and Japan, 3 big markets that our experts feel that you may want to study further and then take a call in terms of your investments. Thank you very much, both Nasser as well as Dinesh, for joining us on the show. These are interesting thoughts and interesting sort of international aspects that we can perhaps consider when it comes to our mutual fund investments. Well, with that, we're out of time. It's a wrap on this week's show. Thank you very much for tuning in. We'll see you with another theme next week.
Let's talk money